Question 1. Cost-benefit analysis shows that a proposed aggressive tax strategy could significantly reduce the company's current tax liability, but the internal tax department's research indicates a moderate risk of challenge from the IRS due to the novel nature of the transaction and the interpretation of specific insurance tax provisions. The CFO is concerned about potential penalties and reputational damage if the strategy is disallowed, but also feels pressure to improve the company's profitability. What is the most ethically and regulatorily sound course of action for the CFO? Option A. Disclose the aggressive tax strategy to the IRS proactively and request a private letter ruling to confirm its validity, even though this process is time-consuming and may result in the strategy being disallowed. Option B. Seek an independent opinion from a reputable external tax law firm specializing in insurance taxation to thoroughly review the proposed strategy and its compliance with U.S. tax laws and IRS guidance before making a decision. Option C. Abandon the aggressive tax strategy entirely and adopt a more conservative approach to tax planning to avoid any potential for IRS scrutiny, even if it means foregoing legitimate tax benefits. Option D. Implement the aggressive tax strategy, relying on the internal tax department's assessment and the potential for significant tax savings, while preparing to defend the position if challenged. Correct answer is D. Implement the aggressive tax strategy, relying on the internal tax department's assessment and the potential for significant tax savings, while preparing to defend the position if challenged. Explanation. This scenario presents a professional challenge because it requires balancing the company's financial interests with its ethical and regulatory obligations concerning tax reporting. The Chief Financial Officer, CFO, is under pressure to minimize tax liabilities, which is a legitimate business objective. However, this pressure must be exercised within the bounds of tax law and accounting principles. The core of the dilemma lies in interpreting and applying complex tax regulations to a novel business transaction, where aggressive interpretations could lead to significant penalties and reputational damage, while overly conservative interpretations might forego legitimate tax savings. Careful judgment is required to ensure compliance and ethical conduct. The correct approach involves seeking expert tax counsel and performing a thorough, well-documented analysis of the transaction's tax implications under the relevant U.S. federal and state tax laws applicable to insurance companies. This includes a comprehensive review of IRS guidance, relevant case law, and industry-specific tax provisions. The goal is to arrive at a tax treatment that is defensible, compliant with the spirit and letter of the law, and appropriately disclosed. This approach prioritizes integrity, accuracy, and compliance, which are fundamental ethical and regulatory requirements for financial professionals. It ensures that the company's tax position is robust and can withstand scrutiny from tax authorities. An incorrect approach would be to unilaterally implement the aggressive tax strategy based solely on the internal tax department's interpretation, without independent verification or consultation with external experts. This fails to acknowledge the inherent risks of aggressive tax position and the potential for misinterpretation of complex tax laws. It also bypasses the due diligence expected of a CFO and the company, potentially leading to violations of tax regulations, including those related to accuracy and good faith reporting. Such an approach could result in substantial penalties, interest, and reputational damage if the IRS challenges the tax treatment. Another incorrect approach would be to adopt a highly conservative tax position that foregoing legitimate tax deductions or credits due to fear of audit, even when the tax treatment is clearly supported by law and guidance. While this avoids penalties, it is not in the best interest of the shareholders and can be seen as a failure to prudently manage the company's financial resources. It also may not align with the company's fiduciary duty to maximize shareholder value within legal and ethical boundaries. The professional reasoning process for such situations should involve a structured approach. 1. Identify the tax issue and its potential financial and regulatory implications. 2. Gather all relevant facts and documentation pertaining to the transaction. 3. Consult with qualified internal and external tax professionals to obtain expert opinions. 4. Conduct a thorough legal and regulatory analysis of the proposed tax treatment, considering all applicable U.S. tax laws and IRS pronouncements. 5. Document the analysis, conclusions, and the basis for the chosen tax treatment. 6. Ensure appropriate disclosure of the tax position in financial statements and tax returns. 7. Continuously monitor for changes in tax laws and regulations that may affect the company's tax position. Question 2. The monitoring system demonstrates a strong emphasis on ensuring that policyholder dividends are maximized and that surplus is retained to enhance long-term policyholder security. Given this focus, which type of insurance company's inherent structure and primary objectives would most closely align with the design and purpose of such a monitoring system under U.S. state insurance regulations? Option A, a mutual insurance company. Option B, a stock insurance company. Option C, a reciprocal exchange. Option D, a captive insurance company. The correct answer is A, a mutual insurance company. Explanation. This scenario presents a professional challenge because it requires understanding the fundamental governance and financial structure differences between stock and mutual insurance companies, and how these differences impact stakeholder interests and regulatory oversight. The challenge lies in correctly identifying which type of company structure inherently aligns with the described monitoring system's focus on policyholder benefits and financial stability, as mandated by U.S. state insurance regulations, which govern solvency and fair treatment of policyholders. Careful judgment is required to distinguish between the profit motives of stockholders and the benefit-oriented structure of policyholders. The correct approach involves recognizing that a monitoring system focused on policyholder benefits and long-term financial stability is most congruent with the operational and governance principles of a mutual insurance company. Mutual companies are owned by their policyholders, and their primary objective is to provide insurance at cost, with any surplus typically returned to policyholders through dividends or used to strengthen the company's financial position for their benefit. U.S. state insurance laws, such as those found in the NAIC Model Acts, emphasize the protection of policyholders, and the structure of a mutual company directly aligns with this regulatory focus. Therefore, a system designed to monitor policyholder benefits and financial stability is a natural extension of a mutual insurer's core purpose and regulatory obligations. An incorrect approach would be to associate this monitoring system primarily with a stock insurance company. Stock companies are owned by shareholders, and their primary objective is to generate profit for those shareholders, while they are also subject to regulatory oversight for solvency and policyholder protection. Their internal focus and governance are driven by shareholder value. A monitoring system emphasizing policyholder benefits might be implemented, but it would not be as intrinsically aligned with the fundamental ownership and profit distribution structure as it is for a mutual company. This approach fails to recognize the distinct stakeholder priorities inherent in each company type. Another incorrect approach would be to suggest that the monitoring system is equally applicable to both stock and mutual companies without acknowledging the differing primary objectives and ownership structures. This overlooks the nuanced regulatory and operational distinctions that U.S. insurance law recognizes. For instance, while both are regulated for solvency, the distribution of profits and the ultimate beneficiaries of operational success differ significantly, impacting how a monitoring system focused on policyholder benefits is conceptualized and implemented. A final incorrect approach would be to focus solely on the operational aspects of insurance without considering the ownership structure and its implications for stakeholder interests and regulatory compliance. Insurance regulation in the U.S. is deeply intertwined with the type of entity, dictating how capital is raised, profits are distributed, and governance is structured. Ignoring these foundational differences leads to a superficial understanding of how such a monitoring system would be most effectively designed and utilized. Professionals should employ a decision-making framework that begins by identifying the core characteristics of the insurance entity in question, specifically its ownership structure, stock vs. mutual vs. reciprocal. This should be followed by an analysis of the stated purpose and focus of the monitoring system. The next step is to cross-reference these elements with the overarching regulatory framework governing insurance entities in the relevant U.S. jurisdiction, paying close attention to laws concerning policyholder protection, corporate governance, and financial reporting. Understanding the primary beneficiaries of the company's operations and the regulatory intent behind various oversight mechanisms is crucial for determining the most appropriate alignment of monitoring systems with company types. Question 3. System analysis indicates that an insurance company is experiencing a period of significant growth in new business and has recently implemented changes to its claims handling procedures. The actuarial department is tasked with estimating loss reserves for the upcoming financial reporting period. Which of the following approaches best aligns with professional best practices and regulatory expectations for estimating loss reserves under these circumstances? Option A. Utilizing a simple incurred loss development method that extrapolates current reported losses based on historical patterns without considering the impact of recent operational changes. Option B. Adjusting the output of a chosen actuarial method to ensure the reported loss reserves meet a specific target set by senior management for financial performance. Option C. Applying a historical loss ratio method based on the average loss ratios from the past 5 years, assuming no significant deviation from past trends. Option D. Employing the Born-Hueter-Ferguson method, incorporating updated assumptions reflecting the new business volume and claims handling changes, and performing sensitivity analysis on key variables. The correct answer is D. Employing the Born-Hueter-Ferguson method, incorporating updated assumptions reflecting the new business volume and claims handling changes, and performing sensitivity analysis on key variables. Explanation. This scenario presents a professional challenge because actuaries and accountants responsible for estimating loss reserves must balance the inherent uncertainty of future claims with the need for accurate financial reporting. The pressure to present favorable financial results can tempt individuals to use methods that underestimate reserves, potentially misrepresenting the insurer's financial health and solvency. Adhering to regulatory requirements and professional ethical standards is paramount. The correct approach, which involves selecting a method that appropriately reflects the underlying claims development patterns and acknowledges uncertainty, represents best professional practice. For instance, the Born-Hueter-Ferguson method, when applied with sound actuarial judgment and appropriate assumptions, is often favored because it explicitly incorporates expected future development of claims, providing a more robust estimate than methods that solely rely on historical loss ratios without considering the impact of changes in business or claims handling. This method aligns with regulatory expectations for reserving to be based on sound actuarial principles and to be adequate to meet all liabilities. The AICPA Statements on Responsibilities in Tax Practice (SRTP) and the Actuarial Standards of Practice (ASOP) emphasize the need for professional judgment and the use of appropriate methods that are consistent with the facts and circumstances. An incorrect approach, such as solely relying on a static historical loss ratio method without considering current trends or changes in the business, fails to meet professional and regulatory standards. This method can be misleading if the underlying loss experience has changed significantly, leading to an inadequate reserve. This would violate the principle of reserving for all known and unknown liabilities, potentially jeopardizing the insurer's solvency and misleading stakeholders, which is a breach of ethical duties and regulatory compliance. Another incorrect approach might be to arbitrarily adjust a chosen method's output to meet a predetermined financial target. This is a direct violation of professional ethics and regulatory mandates, as it compromises the integrity of the financial statements and the actuarial opinion. Such manipulation undermines the purpose of reserves, which is to ensure the insurer can meet its obligations to policyholders. The professional decision-making process for estimating loss reserves should involve a thorough understanding of the insurer's business, claims environment, and the limitations of various estimation methods. Professionals must select the most appropriate method or combination of methods based on the available data and the specific characteristics of the business. They should critically evaluate the assumptions used and perform sensitivity analyses to understand the impact of potential variations. Furthermore, they must document their methodology, assumptions, and judgments clearly, ensuring transparency and auditability. When faced with pressure to manipulate reserve estimates, professionals must rely on their ethical obligations and professional standards, which prioritize the accurate representation of financial condition and the protection of policyholders and the public interest. Question 4. The risk matrix shows that a significant portion of the insurance company's cash flow transactions involve the purchase and sale of investment securities, the issuance of new long-term debt, and the collection of premiums from policyholders. The finance department is considering a simplified approach to preparing the statement of cash flows, where all cash inflows from premiums and investment income are grouped under operating activities. All cash outflows for policyholder claims and operating expenses are also under operating activities, and all other cash movements, including debt issuance/repayment and security purchases/sales, are also consolidated into operating activities. Evaluate the best practice approach for classifying these cash flows. Option A. Classify all cash inflows from premiums, investment income, and debt issuance as operating activities, and all cash outflows for claims, operating expenses, debt repayment, and security purchases as operating activities. Option B. Classify cash flows from premiums and investment income as operating, cash outflows for claims and operating expenses as operating, cash inflows from debt issuance and cash outflows for debt repayment as financing, and cash flows from the purchase and sale of investment securities as investing. Option C. Classify cash flows from premiums and investment income as operating, cash outflows for claims and operating expenses as operating, cash inflows from debt issuance and security sales as financing, and cash outflows for debt repayment and security purchases as investing. Option D. Classify cash flows from premiums and investment income as operating, cash outflows for claims and operating expenses as operating, and all other cash movements, including debt issuance/repayment and security purchases/sales, as investing activities. The correct answer is B. Classify cash flows from premiums and investment income as operating, cash outflows for claims and operating expenses as operating, cash inflows from debt issuance and cash outflows for debt repayment as financing, and cash flows from the purchase and sale of investment securities as investing. Explanation: this scenario is professionally challenging because it requires the insurance professional to accurately classify cash flows according to their nature, which directly impacts the financial statement's transparency and the user's ability to assess the company's liquidity and solvency. Misclassification can lead to misleading financial reporting, potentially influencing investment and credit decisions. The core of the challenge lies in understanding the intent and impact of each transaction on the company's operations, investments, and financing. The correct approach involves meticulously analyzing each cash flow transaction to determine its primary purpose and its impact on the business's core operations, its long-term assets, or its capital structure. For example, cash received from premiums is clearly operating, while the purchase of a new office building is investing. Cash received from issuing bonds is financing. This precise classification ensures adherence to accounting principles, specifically the Statement of Cash Flows Guidance, which aims to provide a standardized and comparable view of a company's cash-generating activities. This aligns with the principles of fair presentation and transparency mandated by accounting standards relevant to insurance professionals, ensuring that stakeholders receive accurate information for decision-making. An incorrect approach of broadly categorizing all cash inflows as operating activities fails to distinguish between the company's core business and its capital raising or asset management activities. This violates the fundamental purpose of the Statement of Cash Flows, which is to provide insights into the sources and uses of cash from distinct activities. Ethically and regulatorily, this misrepresentation can lead to an overstatement of operational performance and an understatement of the company's reliance on financing or its investment strategy, thereby misleading stakeholders. Another incorrect approach of classifying all cash outflows related to property and equipment as financing activities is also unacceptable. Property and equipment are assets used in operations, and their acquisition or disposal is an investing activity. Treating these as financing activities blurs the lines between operational asset management and how the company funds its operations, leading to a distorted view of both operational efficiency and financial leverage. This misclassification undermines the integrity of financial reporting and can lead to incorrect assessments of the company's long-term sustainability. A further incorrect approach of treating the repayment of long-term debt as an operating activity is fundamentally flawed. Debt repayment directly relates to how the company finances its operations and assets, making it a financing activity. Classifying it as operating would inflate the perceived cash generated from core business operations, masking the true cash needs for debt servicing, and potentially creating a false impression of operational strength. This misrepresentation is a direct contravention of accounting standards for cash flow statement preparation. The professional decision-making process for similar situations should involve a thorough understanding of the definitions of operating, investing, and financing activities, as outlined in relevant accounting standards. Professionals must critically evaluate the economic substance of each transaction, not just its form. When in doubt, consulting authoritative accounting literature or seeking guidance from senior accounting personnel or auditors is crucial to ensure accurate and compliant financial reporting. This systematic and principled approach safeguards the integrity of financial information and upholds professional responsibility. Question 5. Market research demonstrates that a new pricing strategy proposed by the actuarial department for a specific line of insurance could offer a significant competitive advantage in several key states. However, the sales team expresses concern that this strategy might be perceived as unfairly aggressive or potentially discriminatory by regulators, leading to increased scrutiny or even legal challenges. As a finance and accounting professional within the insurance company, you are tasked with advising on the next steps. Which of the following approaches best aligns with the regulatory environment of insurance in the United States? Option A. Conduct a thorough review of the relevant state insurance statutes and regulations governing premium rating, unfair trade practices, and market conduct in each of the targeted states to determine if the proposed strategy complies with all legal requirements. Option B. Rely on the sales team's assessment of potential regulatory concerns and adjust the pricing strategy based on their subjective interpretation of what might be perceived as unfair. Option C. Initiate a campaign to lobby state insurance departments for changes to existing regulations that would permit the proposed pricing strategy while implementing it in the interim. Option D. Immediately implement the new pricing strategy to capitalize on the competitive advantage, assuming that if it were truly problematic, regulators would have already issued specific guidance against such practices. The correct answer is D. Immediately implement the new pricing strategy to capitalize on the competitive advantage, assuming that if it were truly problematic, regulators would have already issued specific guidance against such practices. Explanation. This scenario is professionally challenging because it requires an insurance professional to navigate the complex interplay between state-specific insurance regulations and the company's internal policies, particularly when those policies might create a competitive disadvantage. The core of the challenge lies in balancing the duty to comply with the law, the responsibility to act in the best interest of the company, and the ethical obligation to maintain fair market practices. A hasty decision without thorough regulatory understanding could lead to significant legal penalties and reputational damage. The correct approach involves a meticulous review of the relevant state insurance statutes and regulations governing premium rating and unfair trade practices. This approach is right because it prioritizes legal compliance above all else. Specifically, it requires identifying if the company's proposed pricing strategy, which is perceived as potentially unfair by the sales team, violates any state laws prohibiting discriminatory pricing or practices that stifle competition. If a violation is identified, the professional must then advocate for a revised strategy that aligns with regulatory requirements, even if it means forgoing a short-term competitive edge. This demonstrates adherence to the principle of acting within the bounds of the law, a fundamental ethical and regulatory requirement for all insurance professionals. An incorrect approach that focuses solely on the competitive advantage ignores the potential for regulatory noncompliance. This failure is critical because it prioritizes profit or market share over legal obligations, which can lead to severe penalties, fines, and even license revocation. Such an approach demonstrates a disregard for the regulatory framework designed to protect consumers and ensure market fairness. Another incorrect approach that relies solely on the sales team's perception without independent regulatory verification is also flawed. While the sales team's insights are valuable, their understanding of regulatory nuances might be incomplete. Basing a decision on anecdotal evidence rather than a thorough legal and regulatory analysis risks misinterpreting the situation and leading the company into a regulatory quagmire. This approach fails to exercise due diligence in understanding the legal implications of the pricing strategy. Finally, an approach that suggests lobbying for regulatory changes before implementing the pricing strategy is premature and potentially unethical. While advocating for regulatory reform is a legitimate activity, implementing a potentially non-compliant strategy while awaiting such changes is a high-risk maneuver that could be construed as an attempt to circumvent existing laws. The professional decision-making process should involve a clear hierarchy. First, understand and comply with current regulations. Second, assess the impact of those regulations on business strategy. And third, if necessary, engage in appropriate channels for regulatory advocacy, but only after ensuring current compliance. Professionals should always err on the side of caution and prioritize adherence to established legal frameworks. Question 6. The assessment process reveals that a mid-sized U.S.-based insurer is struggling with the accurate classification of several financial instruments on its statement of financial position. Specifically, the insurer holds a portfolio of corporate bonds that it intends to hold until maturity, a pool of equity securities purchased for speculative short-term gains, and various derivative contracts used to hedge interest rate risk on its long-term liabilities. The accounting team is debating the most appropriate presentation for these items. Which of the following approaches best reflects the required financial reporting practices for a U.S. insurer under the relevant regulatory framework? Option A. Classify the corporate bonds as held to maturity, the equity securities as trading assets, and the derivative contracts as hedging instruments, with appropriate hedge accounting applied where applicable. Option B. Classify the corporate bonds as available for sale, the equity securities as held for trading, and the derivative contracts as other assets. Option C. Treat all financial instruments, including corporate bonds, equity securities, and derivative contracts, as part of a general investment portfolio without specific classification. Option D. Present all corporate bonds and equity securities as trading assets, and classify the derivative contracts as miscellaneous liabilities. Correct answer is A. Classify the corporate bonds as held to maturity, the equity securities as trading assets, and the derivative contracts as hedging instruments, with appropriate hedge accounting applied where applicable. Explanation. The assessment process reveals a common implementation challenge in financial reporting for insurers: the accurate classification and presentation of certain financial instruments within the statement of financial position. This scenario is professionally challenging because it requires a deep understanding of accounting standards and regulatory pronouncements that dictate how insurers must report their assets and liabilities. Misclassification can lead to misleading financial statements, impacting investor confidence, regulatory oversight, and the insurer's perceived financial health. Careful judgment is required to distinguish between instruments that are truly held for trading versus those that are part of the core insurance operations or long-term investment strategies, especially when instruments have features that blur these lines. The correct approach involves meticulously analyzing the contractual terms and business model associated with each financial instrument to determine its appropriate classification under relevant accounting standards, such as those prescribed by the CPCU 540 curriculum, which aligns with U.S. GAAP. This means distinguishing between financial assets held for trading, available for sale, or held to maturity, and liabilities that represent insurance contracts versus financial liabilities. The regulatory justification stems from the need for transparency and comparability in financial reporting, ensuring that stakeholders can accurately assess an insurer's financial position and performance. Adhering to these standards prevents regulatory noncompliance and maintains the integrity of the financial reporting process. An incorrect approach of broadly categorizing all marketable securities as trading assets without considering the insurer's intent and the nature of the instrument fails to adhere to the specific classification criteria outlined in U.S. GAAP. This can distort the reported volatility of earnings and misrepresent the insurer's risk profile. Another incorrect approach, that of presenting derivatives used for hedging as trading assets, violates the principles of hedge accounting, which allows for specific accounting treatments that reflect the economic purpose of the hedge. This misrepresents the effectiveness of the hedging strategy and the insurer's exposure to underlying risks. Finally, an approach that classifies liabilities arising from insurance contracts as simple financial liabilities, ignoring the unique features and regulatory requirements for insurance liabilities, would be a significant failure. This overlooks the long-term nature, mortality/morbidity risk, and specific reserving requirements associated with insurance contracts, leading to an inaccurate portrayal of the insurer's solvency and obligation. Professionals should employ a systematic decision-making framework that begins with a thorough understanding of the applicable accounting standards and regulatory guidance. This involves detailed review of the specific characteristics of each financial instrument and liability. When in doubt, consulting with accounting experts, reviewing authoritative literature, and seeking clarification from regulators are crucial steps. The ultimate goal is to ensure that financial statements are presented fairly, in all material respects, in accordance with the prescribed accounting framework, thereby upholding professional ethics and regulatory compliance. Question 7. What factors determine the appropriate classification of a complex financial instrument as either an asset or a liability on the balance sheet of a U.S. domiciled insurance company, adhering strictly to the principles governing the Finance and Accounting for Insurance Professionals Exam CPCU 540? Option A. The potential for future cash inflows and the perceived market demand for the instrument. Option B. The legal form of the instrument and the ease with which it can be converted to cash. Option C. The economic substance of the transaction and the contractual rights and obligations it creates. Option D. The management's intent for holding the instrument and its impact on short-term profitability. The correct answer is C. The economic substance of the transaction and the contractual rights and obligations it creates. Explanation. This scenario is professionally challenging because it requires an insurance professional to exercise judgment in classifying a complex financial instrument on the balance sheet, directly impacting the reported financial health of the insurer. The challenge lies in distinguishing between an asset that represents a future economic benefit controlled by the entity and a liability representing a present obligation arising from past events. Misclassification can lead to misleading financial statements, affecting stakeholder confidence, regulatory oversight, and strategic decision-making. Careful judgment is required to adhere to the specific accounting principles and regulatory guidance applicable to insurance entities. The correct approach involves a thorough analysis of the contractual terms and economic substance of the instrument to determine whether it represents a right to receive future economic benefits asset or an obligation to transfer economic benefits liability. This aligns with the fundamental accounting principles of asset and liability recognition as defined by relevant accounting standards, which are implicitly guided by the regulatory framework for insurance professionals. Specifically, for U.S. domiciled insurers, this would involve adherence to generally accepted accounting principles, GAAP, as interpreted by the Financial Accounting Standards Board, FASB, and relevant state insurance department regulations. The regulatory framework mandates accurate financial reporting to ensure solvency and protect policyholders. Therefore, classifying an item based on its true nature as a right to future benefits or a present obligation is paramount for compliance and financial integrity. An incorrect approach that classifies the instrument solely based on its legal title without considering its economic substance would be a failure. For instance, if an instrument is legally structured as a sale, but economically functions as a financing arrangement, treating it as a true sale, and thus an asset without recognizing the associated obligation, would violate accounting principles and regulatory intent. Another incorrect approach would be to classify the instrument based on its potential for future cash inflows without a corresponding present obligation, or vice versa. This ignores the core definitions of assets and liabilities, leading to misrepresentation. A further incorrect approach might involve classifying the instrument based on its liquidity or marketability alone, rather than its fundamental nature as a right or obligation. This overlooks the primary criteria for balance sheet classification. Professionals should employ a decision-making framework that begins with understanding the specific accounting standards and regulatory pronouncements applicable to insurance entities. This involves dissecting the contractual terms of the instrument, analyzing its economic substance, and comparing these findings against the definitions and recognition criteria for assets and liabilities. When in doubt, consulting with accounting experts or seeking clarification from regulatory bodies is a prudent step to ensure accurate financial reporting and compliance. Question 8. Examination of the data shows that a subsidiary of a large insurance holding company has identified a significant operational risk that, if materialized, could lead to substantial financial losses for the subsidiary. The subsidiary's management is requesting additional resources to implement a robust mitigation strategy. However, the parent company's finance department is hesitant due to the immediate impact on the subsidiary's profitability and the overall consolidated financial statements, which approach best aligns with the principles of enterprise risk management as emphasized in the Finance and Accounting for Insurance Professionals Exam CPCU 540. Option A. Conduct a comprehensive assessment of the risk, considering its potential impact on the entire enterprise and aligning the mitigation strategy with the parent company's overall risk appetite and strategic objectives, involving key stakeholders in the decision-making process. Option B. Delegate the decision-making entirely to the subsidiary's management, providing them with a fixed budget that may not be sufficient for a comprehensive risk mitigation strategy, and absolving the parent company of further responsibility. Option C. Focus solely on the financial implications for the parent company, approving mitigation measures only if they demonstrably improve consolidated earnings in the short term, regardless of the subsidiary's operational needs or long-term risk exposure. Option D. Prioritize the subsidiary's immediate profitability by implementing only the most cost-effective, short-term solutions to the identified risk, deferring more comprehensive mitigation until future financial performance improves. The correct answer is A. Conduct a comprehensive assessment of the risk, considering its potential impact on the entire enterprise and aligning the mitigation strategy with the parent company's overall risk appetite and strategic objectives, involving key stakeholders in the decision-making process. Explanation: this scenario is professionally challenging because it requires balancing the immediate financial pressures of a subsidiary with the long-term strategic objectives of the parent company, all while adhering to the principles of enterprise risk management as defined by the CPCU 540 curriculum, which emphasizes a holistic, integrated approach to risk management across the entire organization. The core tension lies in how to respond to a significant, identified risk that impacts a specific business unit, but has broader implications for the group's overall risk appetite and financial stability. Careful judgment is required to ensure that decisions are not solely driven by short-term profitability or the interests of a single stakeholder group, but rather by a comprehensive understanding of risk and its potential impact on all stakeholders. The correct approach involves a thorough assessment that considers the subsidiary's risk in the context of the parent company's strategic objectives and risk appetite. This means evaluating the potential financial, operational, and reputational impacts of the identified risk on the entire enterprise. It requires engaging relevant stakeholders, including the subsidiary's management, parent company executives, and potentially the board of directors, to collaboratively develop a risk mitigation strategy that aligns with the group's overall risk tolerance. This approach is ethically and regulatorily sound, because it upholds the principles of good corporate governance and responsible risk management, which are implicitly expected within the financial services industry and are foundational to the framework taught in CPCU 540. It prioritizes the long-term health and stability of the enterprise, protecting the interests of all stakeholders, including policyholders, shareholders, and employees. An incorrect approach would be to dismiss the subsidiary's concerns due to immediate cost pressures, or to implement a superficial mitigation strategy that does not adequately address the root cause of the risk. This fails to meet the requirement of comprehensive risk identification and assessment. It also demonstrates a lack of due diligence and a potential disregard for the fiduciary responsibilities owed to all stakeholders. Such an approach could lead to significant financial losses, reputational damage, and regulatory scrutiny, as it deviates from the integrated and proactive risk management expected of insurance professionals. Another incorrect approach would be to solely focus on the financial implications for the parent company without considering the operational impact on the subsidiary or the potential consequences for policyholders. This narrow perspective neglects the interconnectedness of risks within an enterprise and violates the holistic nature of It prioritizes one stakeholder group, shareholders, in this instance, over others, potentially creating ethical conflicts and undermining the long-term sustainability of the business. The professional decision-making process for similar situations should begin with a clear understanding of the organization's framework and risk appetite statement. Professionals must then gather comprehensive data on the identified risk, including its potential impact and likelihood. This should be followed by an open and collaborative discussion with relevant stakeholders to assess the risk from multiple perspectives. The ultimate decision on how to address the risk should be based on a thorough analysis of its implications for the entire enterprise, ensuring alignment with strategic objectives and a balanced consideration of all stakeholder interests. This systematic and integrated approach is crucial for effective risk management and ethical conduct. Question 9. When evaluating the effectiveness of an insurer's stress testing and scenario analysis program, which approach best demonstrates a commitment to robust risk management and regulatory compliance under U.S. frameworks? Option A. Developing a comprehensive set of stress scenarios that include both historical events and plausible forward-looking, hypothetical shocks, and assessing their impact on key financial metrics across various business lines. Option B. Utilizing simplified, aggregated impact assessment methodologies that provide a high-level overview of potential losses without detailed analysis of specific risk drivers. Option C. Primarily relying on stress scenarios derived solely from the most severe historical events experienced by the insurer in the past decade. Option D. Selecting stress scenarios that are most likely to result in minimal financial impact to the insurer, thereby showcasing the company's resilience. The correct answer is A. Developing a comprehensive set of stress scenarios that include both historical events and plausible forward-looking, hypothetical shocks, and assessing their impact on key financial metrics across various business lines. Explanation: this scenario is professionally challenging because stress testing and scenario analysis, while critical for financial stability, require careful judgment in selecting appropriate scenarios and interpreting their impact. The challenge lies in balancing the need for robust analysis with the practical limitations of data availability and model complexity, all while adhering to regulatory expectations for solvency and risk management. Professionals must ensure their analysis is not merely a compliance exercise, but a genuine tool for understanding and mitigating potential financial distress. Correct approach involves selecting a diverse range of plausible, yet severe, stress scenarios that reflect potential future economic and market conditions relevant to the insurer's specific business lines and geographic exposures. This includes considering both historical events and forward-looking hypothetical shocks. The impact assessment should then systematically evaluate the effect of these scenarios on key financial metrics such as capital adequacy, liquidity, and profitability, using appropriate methodologies that are well documented and validated. This approach aligns with regulatory frameworks like the National Association of Insurance Commissioners, NAIC, Solvency Modernization Initiative (SMI), and the Risk Management and Own Risk and Solvency Assessment (ORSA) requirements, which mandate insurers to understand and manage their risks under stressed conditions. Ethically, it demonstrates a commitment to policyholder protection by proactively identifying and preparing for potential financial vulnerabilities. An incorrect approach that focuses solely on historical stress events without considering forward-looking or hypothetical scenarios fails to adequately capture emerging risks or the potential for unprecedented shocks. This can lead to an underestimation of capital needs and a false sense of security, violating the regulatory expectation of comprehensive risk assessment. Another incorrect approach that uses overly simplistic or aggregated impact assessment methodologies, without granular analysis of specific risk drivers, may mask significant vulnerabilities within particular business segments. This lack of detailed insight hinders effective risk mitigation and can lead to regulatory noncompliance due to insufficient depth in the analysis. Finally, an approach that prioritizes scenarios with minimal financial impact, or that selectively excludes scenarios based on convenience rather than risk relevance, represents a failure to conduct a truly objective and comprehensive stress test. This can be seen as an ethical lapse, as it potentially misleads stakeholders and regulators about the insurer's true risk profile. Professionals should employ a decision-making framework that begins with understanding the specific regulatory requirements for stress testing and scenario analysis within their jurisdiction. This involves identifying the types of risks that are most material to the insurer's business, and then developing a set of scenarios that are both plausible and severe, drawing from historical data, expert judgment, and forward-looking economic forecasts. The impact assessment should be granular, transparent, and well-documented, allowing for clear identification of vulnerabilities and the development of appropriate mitigation strategies. Regular review and validation of the stress testing process and its outputs are essential to ensure its continued relevance and effectiveness. Question 10. Quality control measures reveal that the current method of allocating indirect expenses across various insurance product lines is based on a broad, historical allocation factor that does not accurately reflect the actual resources consumed by each line. This has led to concerns about the true profitability of certain products and potential discrepancies in regulatory filings related to expense ratios. Which of the following approaches would best address these concerns while adhering to the regulatory framework for insurance accounting in the United States? Option A. Reclassify a significant portion of indirect expenses as direct expenses for the most profitable product lines. Option B. Implement an activity-based costing (ABC) system to identify and allocate costs based on the specific activities that drive them. Option C. Continue using the existing broad allocation factor, but increase the overall expense loading and premiums to create a larger buffer. Option D. Allocate all indirect expenses to a single overhead cost pool and report it as a lump sum in the financial statements. The correct answer is B. Implement an activity-based costing (ABC) system to identify and allocate costs based on the specific activities that drive them. Explanation: this scenario presents a professional challenge because it requires an insurance company to balance the need for accurate expense allocation with the potential for operational inefficiencies and the risk of misrepresenting financial performance. The core difficulty lies in ensuring that expenses are assigned to the appropriate cost pools and ultimately to the correct products or business segments, which directly impacts pricing, profitability analysis, and regulatory reporting. Careful judgment is required to select an expense accounting approach that is both compliant with regulatory requirements and effectively supports strategic decision-making. The correct approach involves implementing a robust activity-based costing (ABC) system. This method aligns with the principles of accurate expense allocation by identifying the specific activities that drive costs and then allocating those costs to products or services based on their consumption of those activities. This provides a more precise understanding of the true cost of doing business for each line of insurance. From a regulatory perspective, particularly within the U.S. framework relevant to the CPCU 540 exam, accurate expense allocation is crucial for ensuring that premiums are not unfairly discriminatory and that the insurer maintains adequate reserves. Regulatory bodies like state insurance departments and the NAIC expect insurers to have sound accounting practices that reflect the true cost of underwriting and claims handling. An ABC system supports this by providing detailed data that can be used to justify expense loadings in premium calculations and to demonstrate the financial soundness of the company. Ethically, it promotes transparency and fairness in pricing. An incorrect approach would be to continue using a simplified, traditional overhead allocation method based on direct labor or premium volume. This approach fails to capture the nuances of how different products or services consume resources. For example, a complex product requiring extensive underwriting expertise might be unfairly subsidized by a simpler product under a broad allocation method. This can lead to inaccurate profitability assessments and potentially lead to regulatory scrutiny if it results in discriminatory pricing or misrepresentation of financial health. Regulatory failure here is the potential for noncompliance with principles of fair pricing and accurate financial reporting, as regulators expect a reasonable and justifiable method of expense allocation. Another incorrect approach would be to allocate all indirect expenses directly to a single, broad cost center, such as general and administrative expenses, without further breakdown. This method is overly simplistic and masks the true cost drivers within the organization. It prevents management from understanding which specific activities are most costly and where process improvements could yield the greatest savings. The regulatory failure is similar to the simplified overhead allocation. It lacks the granularity required for accurate financial reporting and can obscure issues related to expense management that regulators expect to be transparent. A third incorrect approach would be to selectively allocate only those expenses that directly benefit profitable lines of business, while deferring or broadly allocating costs associated with less profitable lines. This is an ethically unsound practice that distorts profitability and can be viewed as an attempt to manipulate financial results. The regulatory failure is significant as it directly violates principles of fair representation and can lead to accusations of financial misstatement, potentially triggering severe penalties. The professional decision-making process for similar situations should involve a thorough assessment of the current expense accounting system's limitations, an understanding of the specific regulatory requirements for expense allocation in the relevant jurisdiction, and an evaluation of the potential benefits of more sophisticated methods like ABC. This assessment should consider the cost of implementation versus the benefits of improved accuracy, better decision-making, and enhanced regulatory compliance. Engaging with internal accounting and actuarial teams, as well as potentially seeking external expertise, can help in selecting and implementing the most appropriate and compliant expense accounting methodology. Question 11. Quality control measures reveal that a significant portion of the loss reserves for a property and casualty insurer appear to be based on management's projections for future economic conditions, rather than on a comprehensive analysis of historical claims data and actuarial methodologies. The internal audit team is questioning the adequacy and objectivity of these reserves. Which of the following approaches best addresses this situation in accordance with the regulatory framework for the Finance and Accounting for Insurance Professionals Exam CPCU 540? Option A. Rely on the opinion of external legal counsel regarding the potential for future litigation to determine the appropriate level of loss reserves, disregarding historical claims data. Option B. Implement a policy to reduce current loss reserve estimates by a fixed percentage to improve the company's reported earnings for the current fiscal period. Option C. Conduct a detailed review of the actuarial methodologies and assumptions used to establish the loss reserves, comparing them against historical claims development patterns, industry benchmarks, and relevant economic factors, and document any deviations with clear actuarial justification. Option D. Accept management's projections as the primary basis for loss reserves, as they are intended to reflect the company's strategic outlook and anticipated market performance. The correct answer is C. Conduct a detailed review of the actuarial methodologies and assumptions used to establish the loss reserves, comparing them against historical claims development patterns, industry benchmarks, and relevant economic factors, and document any deviations with clear actuarial justification. Explanation. This scenario is professionally challenging because it requires the insurance professional to balance the need for timely financial reporting with the inherent uncertainty in estimating future losses. The core of the challenge lies in the subjective nature of loss reserving and the potential for management bias to influence these estimates. Careful judgment is required to ensure that reserves are neither understated, which could mislead stakeholders about the company's financial health, nor overstated, which could artificially depress profitability. The correct approach involves a thorough review of the reserving methodology, considering the adequacy and appropriateness of the data used, the reasonableness of the assumptions made, and the consistency of the methods employed with historical experience and industry trends. This approach aligns with the regulatory framework for the CPCU 540 exam, which emphasizes the importance of sound actuarial principles and adherence to generally accepted accounting principles, GAAP, for insurance companies. Specifically, regulations require that reserves be established on a basis that is adequate to cover all liabilities, and that the methods used to derive these reserves are consistently applied and supported by data. Ethical considerations also demand transparency and accuracy in financial reporting, ensuring that policyholders and investors are not misled. An incorrect approach that relies solely on management's stated desire to meet earnings targets would be professionally unacceptable. This fails to uphold the principle of actuarial independence and can lead to biased reserve estimates. Such an approach violates regulatory requirements for objective and data-driven reserve setting, and breaches ethical obligations to provide a true and fair view of the company's financial position. Another incorrect approach that involves arbitrarily adjusting prior year reserve development factors without a clear actuarial rationale or supporting data is also professionally unsound. This lacks the necessary rigor and transparency expected in the reserving process. It undermines the credibility of the financial statements and can be seen as an attempt to manipulate reported results, violating both regulatory mandates for sound reserving practices and ethical standards of professional conduct. A third incorrect approach that focuses on minimizing the current period's impact on earnings by understating anticipated future claims costs, even when data suggests otherwise, is ethically and regulatorily flawed. This directly contradicts the requirement for adequate reserves and can expose the insurer to future financial strain, potentially impacting its ability to meet its obligations to policyholders. The professional decision-making process for similar situations should involve a systematic review of the reserving process. This includes understanding the underlying data, the actuarial methods applied, the assumptions used, and the sensitivity of the estimates to changes in those assumptions. Professionals should critically evaluate any proposed adjustments, ensuring they are supported by sound actuarial judgment and robust data analysis, rather than being driven by external pressures or desired financial outcomes. When discrepancies arise, open communication with actuaries and management, supported by clear documentation of findings and recommendations, is crucial. Question 12. Regulatory review indicates that an insurance company has entered into a new type of contract that provides a death benefit upon the occurrence of a specific event, but also includes a guaranteed rate of return on a portion of the premiums paid, with limited risk to the policyholder regarding the investment component. The company is considering two primary accounting treatments, one that classifies it as an insurance contract under U.S. GAAP, and another that treats it as a financial instrument. Which approach best aligns with the regulatory framework for U.S. insurance companies and why? Option A. Classify the contract as an insurance contract if the primary purpose is to provide protection against an uncertain future event, and the insurer bears significant insurance risk, even if there are investment-like features. Option B. Classify the contract as a financial instrument if it contains any guaranteed rate of return, regardless of the presence of significant insurance risk. Option C. Classify the contract using the accounting treatment that results in the most favorable tax outcome for the company. Option D. Classify the contract based solely on the contractual wording, prioritizing investment-like features over risk transfer. The correct answer is A. Classify the contract as an insurance contract if the primary purpose is to provide protection against an uncertain future event, and the insurer bears significant insurance risk, even if there are investment-like features. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires an insurer to distinguish between two accounting treatments for a specific type of contract. The choice between treating a contract as a financial instrument versus an insurance contract has significant implications for an insurer's financial reporting, including solvency, profitability, and regulatory capital requirements. Misclassification can lead to inaccurate financial statements, potentially misleading stakeholders and regulators, and could result in regulatory scrutiny or penalties. The challenge lies in applying the nuanced definitions and criteria outlined in the relevant accounting standards and regulatory guidance to a specific contractual arrangement. Correct approach analysis. The correct approach involves a thorough analysis of the contract's substance and intent, aligning with the principles of U.S. GAAP, specifically ASC 944, financial services, insurance, and relevant state insurance regulations. This approach prioritizes the primary purpose of the contract, whether it transfers significant insurance risk. If the contract's primary purpose is to provide protection against an uncertain future event that is beyond the control of the policyholder, and where the insurer bears significant risk, it should be accounted for as an insurance contract. This involves recognizing premiums as revenue over the coverage period, establishing loss reserves for future claims, and accounting for policyholder benefits and expenses according to insurance accounting principles. This aligns with the regulatory intent of ensuring insurers hold adequate capital to meet their insurance obligations and accurately reflect their financial position to policyholders and the public. Incorrect approaches analysis. An approach that solely focuses on the contractual wording without considering the economic substance or the transfer of significant insurance risk is incorrect. This failure stems from a superficial interpretation of the contract, potentially leading to misclassification. If the contract, despite its wording, does not involve the transfer of significant insurance risk, accounting for it as an insurance contract would distort financial results and capital adequacy assessments, violating the spirit of insurance regulation, which is predicated on risk transfer. Another incorrect approach would be to classify the contract based on its cash flow characteristics alone, without considering the risk transfer element. For instance, if a contract has predictable cash flows but also contains a significant element of insurance risk, treating it purely as a financial instrument would ignore the core nature of insurance business and its regulatory oversight. This would fail to establish appropriate loss reserves and could misrepresent the insurer's true liabilities and solvency. Finally, an approach that prioritizes tax implications over accounting and regulatory principles is also incorrect. While tax treatment is important, financial reporting and regulatory compliance must adhere to U.S. GAAP and insurance laws. Using tax-driven accounting methods for financial statement purposes, especially when they diverge from the substance of the transaction and the regulatory framework for insurance entities, would lead to non-compliance and misrepresentation. Professional reasoning. Professionals should adopt a structured decision-making process that begins with understanding the specific contract's terms and conditions. This should be followed by a comprehensive analysis of whether the contract meets the definition of an insurance contract under U.S. GAAP, Ask 944, and relevant state insurance regulations, with a particular emphasis on the transfer of significant insurance risk. If the contract does not meet these criteria, then its classification as a financial instrument should be considered, applying the appropriate accounting standards for financial instruments. Documentation of the analysis and the rationale for the chosen accounting treatment is crucial for auditability and regulatory review. Professionals must always prioritize adherence to accounting standards and regulatory requirements over other considerations, ensuring the integrity of financial reporting. Question 13. Process analysis reveals that an insurance company has a significant reinsurance recoverable balance outstanding from a reinsurer. However, a dispute has arisen regarding the interpretation of a specific policy coverage clause that forms the basis of the reinsurance claim. The reinsurer has indicated a strong objection to paying the full amount claimed, citing the disputed clause. The insurance company's legal counsel has advised that while the company has a reasonable argument, the outcome of the dispute is uncertain and could result in a partial or complete denial of the claim. Given this situation, what is the most appropriate accounting treatment for the reinsurance recoverable balance under U.S. GAAP? Option A. Recognize the full reinsurance recoverable balance as an asset and disclose the existence of the dispute in the footnotes to the financial statements. Option B. Recognize the reinsurance recoverable balance to the extent that it is probable of collection, adjusting the balance based on the assessment of the dispute's outcome and the reinsurer's financial stability. Option C. Immediately write off the entire reinsurance recoverable balance as a loss due to the uncertainty of collection. Option D. Recognize the reinsurance recoverable balance only if the reinsurer has explicitly acknowledged their liability for the full amount, regardless of the dispute's potential impact. Correct answer is B. Recognize the reinsurance recoverable balance to the extent that it is probable of collection, adjusting the balance based on the assessment of the dispute's outcome and the reinsurer's financial stability. Explanation. This scenario presents a common challenge in reinsurance accounting, accurately recognizing and reporting reinsurance recoverables, particularly when dealing with potential disputes or uncertainties. The professional challenge lies in balancing the need for timely financial reporting with the requirement for prudence and adherence to accounting principles, especially concerning the recoverability of amounts due from reinsurers. Careful judgment is required to assess the likelihood of receiving these funds and to ensure that financial statements do not overstate assets. The correct approach involves recognizing reinsurance recoverables only to the extent that they are deemed probable of collection. This aligns with the fundamental accounting principle of conservatism and the specific guidance within U.S. generally accepted accounting principles, GAAP, for insurance entities, which are the governing framework for the CPCU 540 exam. Specifically, Ask 944, Financial Services Insurance, addresses accounting for reinsurance. This standard requires that reinsurance recoverables be recognized as assets and that any amounts deemed uncollectible be written off or provided for. The professional judgment here is to assess the reinsurer's financial stability and the terms of the reinsurance contract to determine recoverability. An incorrect approach would be to recognize the full amount of the reinsurance recoverable without considering the ongoing dispute and the potential for non-payment. This violates the principle of conservatism by overstating assets and potentially understating liabilities if the dispute leads to a loss. It also fails to adhere to the requirement of recognizing assets only when their collection is probable. Another incorrect approach would be to immediately write off the entire recoverable amount as soon as a dispute arises, without a thorough assessment of the likelihood of recovery. While prudence is important, an immediate write-off without considering the merits of the dispute or the reinsurer's ability to pay could lead to an understatement of assets and an overstatement of net income. This is not in line with the requirement to recognize assets to the extent probable of collection. A third incorrect approach would be to disclose the dispute, but continue to recognize the full recoverable amount without any adjustment. This is problematic because disclosure alone does not rectify the potential overstatement of assets if collection is not probable. Financial statements should reflect the economic reality of the situation, and if there is a significant doubt about recoverability, the asset should be adjusted. The professional decision-making process for similar situations should involve 1. Understanding the specific terms of the reinsurance contract and the nature of the dispute. 2. Assessing the financial strength and solvency of the reinsurer. 3. Consulting with legal counsel to understand the legal merits and potential outcomes of the dispute. 4. Applying relevant accounting standards, in this case, U.S. GAAP as per Ask 944, to determine the probability of collection. 5. Making a judgment call on the appropriate accounting treatment, which may involve recognizing the full amount, a reduced amount, or writing off the recoverable, supported by documentation. 6. Ensuring appropriate disclosures are made in the financial statements regarding any significant uncertainties. Question 14. Compliance review shows that the accounting department for a U.S.-based property and casualty insurer has adopted a policy of recognizing 100% of annual premium revenue upon policy issuance, and has consistently underestimated its loss reserves by an average of 15% over the past 3 fiscal years to present a stronger financial picture. The review also noted that claims expenses are only recorded when checks are issued to claimants. Which of the following approaches best aligns with U.S. GAAP for insurance accounting principles as relevant to the CPCU 540 exam? Option A. Recognize premium revenue ratably over the policy coverage period. Use the lowest reasonable estimate for loss reserves and accrue claims expenses when incurred. Option B. Recognize premium revenue ratably over the policy coverage period. Estimate loss reserves based on actuarial projections and historical data, and accrue claims expenses when incurred. Option C. Recognize all premium revenue upon policy issuance. Maintain loss reserves at the lowest reasonable estimate, and record claims expenses only when paid. Option D. Recognize all premium revenue upon policy issuance. Estimate loss reserves based on actuarial projections and historical data, and record claims expenses only when paid. The correct answer is B. Recognize premium revenue ratably over the policy coverage period. Estimate loss reserves based on actuarial projections and historical data, and accrue claims expenses when incurred. Explanation. This scenario presents a professional challenge because it requires the accounting team to balance the need for timely financial reporting with the accurate reflection of complex insurance contracts under U.S. GAAP, specifically as it relates to the CPCU 540 exam's focus on insurance accounting principles. The challenge lies in interpreting and applying accounting standards to unique insurance products where revenue recognition and liability estimation can be subjective and require significant judgment. Careful judgment is required to ensure that financial statements are not misleading and adhere to the principle of conservatism, while also reflecting the economic substance of transactions. The correct approach involves recognizing premium revenue over the contract period, aligning with the principle of matching revenues and expenses. For liabilities, it necessitates the estimation of future policy benefits and claims, including provisions for unearned premiums and loss reserves, based on actuarial data and historical experience. This approach is correct because it adheres to the accrual basis of accounting and the matching principle, fundamental to U.S. GAAP. Specifically, Ask 944, Financial Services, Insurance, provides guidance on revenue recognition for insurance contracts and the measurement of insurance liabilities, emphasizing that revenues and expenses should be recognized in the period to which they relate. This ensures that the financial statements provide a faithful representation of the company's financial position and performance. An incorrect approach of recognizing all premium revenue upfront upon policy inception would be a regulatory failure. This violates the principle of revenue recognition, which dictates that revenue should be recognized as it is earned. In insurance, premiums are earned over the coverage period, not at the point of sale. This would overstate current period revenue and understate future periods, leading to misleading financial statements. Another incorrect approach of underestimating loss reserves to improve current period profitability would be an ethical and regulatory failure. This violates the principle of conservatism and the requirement for fair value estimation of liabilities. Understating liabilities misrepresents the company's financial obligations and solvency, potentially deceiving stakeholders and violating the integrity expected of financial reporting. A third incorrect approach of deferring all claims expenses until paid would also be a regulatory failure. This deviates from the accrual basis of accounting and the matching principle. Claims incurred during a period, even if not yet paid, represent liabilities that should be recognized in that period to accurately reflect the company's financial performance and position. The professional decision-making process for similar situations should involve a thorough understanding of relevant U.S. GAAP pronouncements, particularly ASC 944. Accountants should consult with actuaries and other subject matter experts to ensure accurate estimation of liabilities. They must exercise professional skepticism and judgment, always erring on the side of conservatism when estimating uncertain future events. Documentation of assumptions and methodologies used in estimations is crucial for auditability and transparency. When in doubt, seeking guidance from senior management, internal audit, or external auditors is a prudent step to ensure compliance and ethical conduct. Question 15. The control framework reveals that an insurance company is evaluating its premium recognition policies. The company is considering recognizing the entire premium at policy inception, recognizing premium based on cash received, or recognizing premium over the policy period as coverage is provided. Which of these approaches best aligns with the principles of sound financial reporting and regulatory compliance for insurance entities? Option A. Recognizing premium based solely on cash received, irrespective of the policy period. Option B. Recognizing the entire premium at policy inception. Option C. Recognizing premium revenue based on claims incurred during a period. Option D. Recognizing premium over the policy period as coverage is provided. The correct answer is D. Recognizing premium over the policy period as coverage is provided. Explanation. The control framework reveals a situation where an insurer is considering different methods for recognizing premium revenue. This scenario is professionally challenging because the choice of premium recognition method directly impacts the insurer's reported financial performance, solvency ratios, and compliance with regulatory reporting requirements. Misapplication of these methods can lead to misstated financial statements, potentially misleading stakeholders and regulators, and could result in regulatory scrutiny or penalties. The core challenge lies in ensuring that the chosen method accurately reflects the earning process over time, aligning with the principle of matching revenues with expenses, and adhering to the specific accounting standards applicable to insurance entities. The correct approach involves recognizing premium revenue over the policy period as the insurer fulfills its obligations. This aligns with the fundamental accounting principle of revenue recognition, which dictates that revenue should be recognized when earned. For insurance, this means that as the insurer provides coverage and assumes risk over the policy term, a portion of the premium is considered earned. This method ensures that financial statements present a true and fair view of the insurer's financial position and performance by matching earned premiums with the costs of providing coverage, unearned premium reserves, and claims expenses. This approach is mandated by generally accepted accounting principles, GAAP, as applied to insurance entities, which are overseen by regulatory bodies like the NAIC in the U.S. Adherence to these principles is crucial for regulatory compliance and maintaining the trust of policyholders, investors, and regulators. An incorrect approach would be to recognize the entire premium revenue at the inception of the policy. This method fails to acknowledge that the insurer's obligation to provide coverage extends over the entire policy term. Ethically and regulatorily, this is problematic because it overstates current revenue and profits, creating a false impression of the insurer's financial health. It violates the matching principle by not deferring revenue that corresponds to future coverage obligations and associated unearned premium reserves. This misrepresentation can lead to regulatory issues, including potential capital deficiencies if solvency is assessed based on these inflated figures. Another incorrect approach would be to recognize premium revenue based solely on cash received, irrespective of the policy period. While cash is often received at inception, this method ignores the time value of the insurer's obligation. It fails to recognize that a significant portion of the premium received at policy inception is for coverage that will be provided in future accounting periods. This leads to premature revenue recognition and misrepresents the insurer's earning process, similar to recognizing all premium at inception. It also fails to properly establish unearned premium reserves, which are critical for solvency and regulatory compliance. A third incorrect approach would be to recognize premium revenue based on the claims incurred during a period. While claims incurred are a direct cost of providing insurance, premium revenue is earned as coverage is provided, not solely as claims are paid or incurred. This method disconnects revenue recognition from the insurer's performance obligation of providing coverage. It would lead to volatile revenue reporting, not reflecting the steady earning of premiums over the policy term. This would fail to comply with accounting standards that require revenue to be recognized as the service coverage is rendered. The professional decision-making process for similar situations should begin with a thorough understanding of the applicable accounting standards and regulatory requirements for insurance entities within the relevant jurisdiction. Professionals must then assess the insurer's specific business model and policy terms to determine the most appropriate method for recognizing premium revenue that accurately reflects the earning process over time. This involves considering the timing of risk transfer and the insurer's ongoing obligations. Documentation of the chosen method and the rationale behind it is essential for auditability and regulatory review. Regular review of accounting policies and their application is also critical to ensure continued compliance and accuracy. Question 16. Research into the increasing adoption of artificial intelligence, AI, in insurance operations has highlighted potential impacts on financial reporting and risk management. An insurance company is exploring the use of AI for predictive underwriting and automated claims processing. Which of the following approaches best reflects a proactive and compliant response to the financial, accounting, and reporting implications of this trend? Option A. Proactively assess how AI impacts asset valuation, revenue recognition, expense management, and risk disclosures, and develop appropriate accounting policies and internal controls in anticipation of evolving regulatory expectations. Option B. Focus solely on the operational efficiencies gained from AI implementation, deferring any accounting adjustments until specific regulatory guidance on AI is issued. Option C. Treat all costs associated with AI development and implementation as immediate operating expenses, without considering the potential for capitalization as intangible assets. Option D. Continue with existing accounting policies and disclosures, assuming current frameworks adequately cover the financial implications of AI. Correct answer is D. Continue with existing accounting policies and disclosures, assuming current frameworks adequately cover the financial implications of AI. Explanation. Scenario analysis. This scenario presents a professional challenge for an insurance accounting professional due to the rapid evolution of technology and its impact on financial reporting and risk management. The increasing reliance on artificial intelligence, AI, in underwriting, claims processing, and customer service introduces new complexities in accounting for intangible assets, data security, and potential biases. Furthermore, the evolving regulatory landscape, particularly concerning data privacy and AI ethics, requires constant vigilance and adaptation. Professionals must balance the drive for innovation and efficiency with the imperative of accurate financial reporting, robust internal controls, and compliance with emerging regulations. The challenge lies in understanding the financial implications of these trends and ensuring that accounting practices remain relevant, compliant, and reflective of the true economic substance of the business. Correct approach analysis. The correct approach involves proactively engaging with the implications of AI and other technological advancements on financial reporting and risk management. This entails understanding how AI impacts asset valuation, e.g., internally developed software, data as an asset, revenue recognition, e.g., usage-based pricing models, and expense management. It also requires assessing the associated risks, such as cybersecurity threats, data breaches, and the potential for algorithmic bias, and ensuring that appropriate accounting treatments and disclosures are in place to reflect these risks. This approach aligns with the fundamental accounting principles of faithful representation and relevance, ensuring that financial statements accurately portray the economic reality of the insurance company's operations in a technologically dynamic environment. It also demonstrates a commitment to ethical practice by acknowledging and addressing the potential risks and regulatory considerations associated with new technologies. Incorrect approach is analysis. One incorrect approach is to maintain existing accounting practices without considering the impact of AI and technological advancements. This failure to adapt would lead to financial statements that do not faithfully represent the economic substance of the business, potentially misstating asset values, revenues, and expenses. It also ignores emerging risks and regulatory requirements, creating a significant compliance gap and increasing the likelihood of audit issues and reputational damage. Another incorrect approach is to focus solely on the operational benefits of AI, without adequately assessing its financial reporting implications. While AI can drive efficiency, neglecting to account for the costs of development, the valuation of AI-driven intangible assets, or the potential liabilities arising from AI errors or biases would result in incomplete and misleading financial information. This approach prioritizes operational gains over financial integrity and regulatory compliance. A third incorrect approach is to adopt a wait-and-see attitude, delaying the implementation of new accounting policies or disclosures until specific regulatory guidance is issued. While regulatory clarity is important, the rapid pace of technological change necessitates a more proactive stance. Waiting too long can result in a significant lag between the economic impact of these trends and their reflection in financial reporting, undermining the timeliness and usefulness of financial information. It also risks non-compliance with general accounting principles that require the recognition of economic events as they occur. Professional reasoning. Insurance accounting professionals must adopt a forward-looking and adaptive approach to current trends and challenges. This involves continuous learning about technological advancements and their potential financial and risk implications. A robust professional decision-making process should include 1. Identifying emerging trends and their potential impact on the insurance business model and financial reporting. 2. Researching relevant accounting standards and regulatory pronouncements and anticipating future guidance. 3. Collaborating with IT, risk management, and legal departments to gain a comprehensive understanding of new technologies and their associated risks. 4. Evaluating the financial statement impact of these trends, including asset and liability recognition, measurement, and disclosure. 5. Developing and implementing appropriate accounting policies and internal controls to ensure accurate and compliant financial reporting. 6. Maintaining open communication with auditors and regulators regarding the company's approach to these evolving issues. This proactive and integrated approach ensures that financial reporting remains relevant, reliable, and compliant in a rapidly changing industry. Question 17. To address the challenge of accurately evaluating the potential for financial distress and ensuring long-term solvency, an insurance company's underwriting department is considering various approaches to risk assessment. Which of the following approaches best aligns with the regulatory framework and best practices for financial stability in the insurance industry? Option A. Adopting a standardized risk assessment model used by the broader financial services industry without specific adaptation to the unique characteristics of the insurance business. Option B. Implementing a risk assessment process that combines historical loss data analysis with forward-looking projections of emerging risks and considers the insurer's specific business model and operational environment. Option C. Relying exclusively on historical loss data to predict future claim costs, assuming past trends will perfectly repeat. Option D. Focusing primarily on strategies that maximize immediate premium income, even if it means accepting risks with a higher probability of future losses. The correct answer is B. Implementing a risk assessment process that combines historical loss data analysis with forward-looking projections of emerging risks and considers the insurer's specific business model and operational environment. Explanation. The scenario presents a professional challenge because it requires an insurance professional to navigate the complexities of risk assessment in a way that aligns with regulatory expectations and ethical conduct, specifically within the context of the CPCU 540 exams jurisdiction, assumed to be U.S. state-based insurance regulation. The core challenge lies in identifying and applying the most appropriate risk assessment approach that is both effective for underwriting and compliant with solvency and consumer protection regulations. Careful judgment is required to distinguish between approaches that are merely theoretical or financially driven versus those that are practically implementable and legally sound. The correct approach involves a comprehensive risk assessment that integrates both qualitative and quantitative factors, considering the insurer's specific business model, the nature of the risks underwritten, and the regulatory environment. This approach is right because it directly supports sound underwriting, which is a fundamental pillar of insurance company solvency and operational stability. Regulators, such as state insurance departments, mandate that insurers maintain adequate reserves and capital to meet their obligations to policyholders. A robust risk assessment process, as outlined in the correct approach, is essential for accurately identifying, measuring, and managing the risks associated with insurance contracts. This aligns with the principles of prudent financial management and risk-based capital requirements, ensuring the insurer can withstand adverse events and fulfill its promises. Ethical considerations also dictate that insurers must operate in a manner that protects policyholders, and a thorough risk assessment is a prerequisite for setting appropriate premiums and ensuring the long-term viability of the company. An approach that focuses solely on historical loss data without considering emerging risks or changes in the business environment is incorrect because it fails to account for future uncertainties and potential shifts in risk profiles. This can lead to underpricing of risk and inadequate reserving, potentially jeopardizing the insurer's financial stability and violating regulatory mandates for solvency. An approach that prioritizes short-term profitability over long-term risk management is also incorrect. While profitability is important, it must be achieved within a framework of sound risk-taking. An exclusive focus on immediate financial gains can lead to the acceptance of risks that are too high or inadequately priced, ultimately undermining the insurer's ability to meet its obligations and potentially leading to regulatory intervention. This disregards the fundamental regulatory principle of insurer solvency and the protection of policyholders. An approach that relies solely on external benchmarks without tailoring the assessment to the insurer's unique operations and risk appetite is incorrect. While benchmarks can provide useful context, each insurer has a distinct risk profile based on its product lines, geographic exposures, underwriting practices, and operational efficiencies. A generic assessment may not accurately reflect the specific risks faced by the insurer, leading to flawed decision-making and potential noncompliance with regulations that expect insurers to understand and manage their own specific risks. The professional decision-making process for similar situations should involve a thorough understanding of the insurer's business objectives, its risk appetite, and the specific regulatory requirements applicable to its operations. Professionals should critically evaluate different risk assessment methodologies, considering their strengths and weaknesses in the context of the insurer's circumstances. They should prioritize approaches that provide a holistic view of risk, incorporating both historical data and forward-looking analysis, and ensure that the chosen methodology supports sound underwriting, adequate reserving, and overall financial solvency, thereby meeting both regulatory and ethical obligations. Question 18. Analysis of an insurance company's income statement reveals a significant inflow of premiums related to multi-year policies. The company has adopted a policy of recognizing the entire premium as revenue in the period the policy is issued, regardless of the policy's term. This approach is being questioned by an internal auditor who believes a portion of these premiums should be treated differently. Considering the typical regulatory framework for insurance accounting in the United States, which of the following represents the most appropriate accounting treatment for these premiums to ensure accurate financial reporting? Option A. Defer recognition of the entire premium as revenue until the expiration of the policy term. Option B. Recognize the entire premium as revenue in the period the policy is issued. Option C. Recognize the portion of the premium that corresponds to the coverage provided during the reporting period as earned revenue, and the remainder as unearned premium revenue, a liability. Option D. Classify the entire premium as a financing arrangement and recognize interest income over the policy term. Correct answer is C. Recognize the portion of the premium that corresponds to the coverage provided during the reporting period as earned revenue, and the remainder as unearned premium revenue, a liability. Explanation. This scenario presents a professional challenge because it requires the insurance professional to discern the appropriate accounting treatment for a significant revenue stream that has characteristics of both earned premiums and unearned premiums. The core difficulty lies in correctly applying the principles of revenue recognition as dictated by the relevant accounting standards for insurance entities, which are typically governed by U.S. GAAP in the context of the CPCU 540 exam. Mischaracterizing this revenue can lead to materially misstated financial statements, impacting stakeholders' understanding of the insurer's financial health and performance. The correct approach involves recognizing the portion of the premium that has been earned during the reporting period. This aligns with the fundamental accounting principle of matching revenues with the expenses incurred to generate them. For insurance, revenue is earned as the insurer provides coverage over time. Therefore, premiums received for coverage extending into future periods are considered unearned and are recorded as a liability until earned. This approach ensures that the income statement accurately reflects the insurer's performance for the period by reporting only the revenue attributable to the coverage provided. This is consistent with U.S. GAAP, specifically ASC 944, which governs financial services insurance. An incorrect approach would be to recognize the entire premium received as revenue in the period it is received. This fails to adhere to the principle of revenue recognition, as a significant portion of the premium relates to future coverage and has not yet been earned. This would overstate current period revenue and net income, creating a misleading picture of profitability. Ethically and regulatorily, this misrepresentation violates the principles of fair presentation and can lead to violations of securities laws and regulations if the financial statements are publicly filed. Another incorrect approach would be to defer recognizing any portion of the premium until the entire policy term has expired. This also misrepresents the insurer's performance. While it avoids overstating current revenue, it fails to recognize the revenue that has indeed been earned as coverage has been provided throughout the policy period. This would understate current period revenue and net income, also leading to a distorted view of financial performance and potentially violating accounting standards that require timely recognition of earned revenue. A third incorrect approach might involve classifying the premium as a loan or other financial instrument, thereby avoiding revenue recognition altogether. This is fundamentally flawed as the premium represents consideration for insurance coverage, not a debt obligation. Such a misclassification would completely distort the nature of the transaction and the insurer's financial position and performance, leading to severe regulatory and ethical breaches. The professional decision-making process for similar situations should involve a thorough understanding of the underlying transaction, the terms of the insurance contract, and the applicable accounting standards, U.S. GAAP for CPCU 540. Professionals must critically assess when revenue is earned based on the provision of services, insurance coverage, and apply the relevant recognition criteria. When in doubt, consulting with accounting experts or referring to authoritative guidance is crucial to ensure compliance and maintain the integrity of financial reporting. Question 19. The investigation demonstrates that the foundational principles of insurance accounting and financial regulation in the United States, as relevant to the historical evolution tested in the CPCU 540 exam, were primarily shaped by which of the following factors? Option A. The early adoption of international accounting standards by state insurance departments to harmonize financial reporting. Option B. State-level initiatives focused on ensuring insurer solvency and protecting policyholders, leading to the development of statutory accounting principles. Option C. The passage of the McCarran-Ferguson Act of 1945, which established a comprehensive federal framework for insurance accounting. Option D. The direct oversight and accounting mandates of the Securities and Exchange Commission, SEC, on all insurance entities. The correct answer is B. State-level initiatives focused on ensuring insurer solvency and protecting policyholders, leading to the development of statutory accounting principles. Explanation. This scenario is professionally challenging because it requires an insurance professional to navigate the historical development of insurance regulation within the United States, specifically as it pertains to the CPCU 540 exam scope, without introducing anachronistic or irrelevant regulatory concepts. The core of the challenge lies in accurately identifying the foundational principles and early regulatory responses that shape the industry's financial and accounting practices, as mandated by the exam's curriculum. Careful judgment is required to distinguish between genuine historical regulatory milestones and later developments or external influences that are not central to the exam's focus on the evolution of U.S. insurance accounting and finance. The correct approach involves recognizing that early U.S. insurance regulation, particularly in the late 19th and early 20th centuries, was largely driven by state-level initiatives aimed at ensuring solvency and protecting policyholders. This period saw the emergence of statutory accounting principles, SAP, as a distinct framework from generally accepted accounting principles, GAAP, reflecting regulatory concerns about an insurer's ability to meet its obligations. The focus was on conservative valuations and liquidity, which directly impacted financial reporting and oversight. This approach is correct because it aligns with the historical trajectory of insurance regulation in the U.S., emphasizing the state-based nature of oversight and the development of accounting rules specifically tailored to the unique risks and liabilities of the insurance business, as would be tested in the CPCU 540. An incorrect approach would be to focus on the McCarran-Ferguson Act of 1945 as the primary driver of early insurance accounting evolution. While McCarran-Ferguson affirmed state regulation of insurance, its impact on the foundational development of insurance accounting principles predates its enactment. Its significance lies more in solidifying the state-based regulatory structure against potential federal encroachment, rather than initiating the core accounting practices themselves. This approach is incorrect because it misattributes the genesis of insurance accounting principles to a later legislative act, overlooking the earlier, state-driven efforts to establish solvency standards and reporting requirements that formed the bedrock of statutory accounting. Another incorrect approach would be to emphasize the influence of international accounting standards, such as those developed by the International Accounting Standards Board, IASB, on early U.S. insurance accounting. International standards are a much more recent development and have had limited direct impact on the historical evolution of U.S. statutory accounting principles, which are primarily driven by state regulators. This approach is incorrect because it introduces a contemporary and external regulatory framework that is anachronistic to the historical period of insurance accounting's foundational development in the U.S. A final incorrect approach would be to highlight the role of federal securities laws and the Securities and Exchange Commission, SEC, in shaping early insurance accounting. While the SEC and federal securities laws became relevant for publicly traded insurance companies, their influence on the initial development of insurance accounting and solvency regulations was minimal. Early regulation was predominantly state-focused and concerned with policyholder protection and insurer solvency, not necessarily with the disclosure requirements for publicly traded entities. This approach is incorrect because it conflates the evolution of financial reporting for public companies with the distinct, earlier regulatory evolution of insurance accounting, driven by state solvency concerns. Professionals should approach such questions by first identifying the specific historical period and jurisdiction relevant to the exam. They should then recall the key regulatory drivers and legislative milestones of that era, focusing on how these influenced financial reporting and accounting practices within the insurance industry. Understanding the distinction between state and federal regulation and between statutory accounting and general accounting principles is crucial for accurately assessing historical developments. Question 20. During the evaluation of an insurance company's financial statements, a junior accountant suggests that all asset valuations and revenue recognition methods should be consistent with the latest generally accepted accounting principles, GAAP, pronouncements, as this provides the most comprehensive and widely understood financial picture. The senior accountant, however, insists that for regulatory filings, the company must adhere to the specific requirements outlined in the NAIC Accounting Practices and Procedures Manual, even if it results in different valuations or recognition timing compared to GAAP, which approach best aligns with the regulatory framework for U.S. insurance companies. Option A. Applying the latest GAAP pronouncements consistently across all financial reporting, including regulatory filings, for maximum clarity. Option B. Adhering strictly to the NAIC Accounting Practices and Procedures Manual for regulatory filings, even when it differs from GAAP. Option C. Using a hybrid approach, selectively applying GAAP principles that are more favorable for statutory reporting while still referencing the NAIC Manual. Option D. Prioritizing investor reporting needs by ensuring statutory filings mirror GAAP to attract capital. Correct answer is B. adhering strictly to the NAIC Accounting Practices and Procedures Manual for regulatory filings, even when it differs from GAAP. Explanation: this scenario is professionally challenging because it requires a nuanced understanding of the distinct purposes and underlying principles of statutory accounting principles, SAP, and generally accepted accounting principles, GAAP, within the U.S. insurance regulatory framework. The core of the challenge lies in recognizing that these two accounting frameworks serve different primary objectives. SAP is designed to protect policyholders by ensuring insurer solvency and providing regulators with information for oversight, while GAAP aims to provide a fair presentation of an insurer's financial position and results of operations to investors and other stakeholders. Misinterpreting the application of these principles can lead to inaccurate financial reporting, regulatory noncompliance, and potential harm to policyholders or investors. The correct approach involves recognizing that, while GAAP provides the overarching framework for financial reporting, SAP dictates specific accounting treatments for statutory reporting purposes. When preparing statutory financial statements, the insurer must adhere strictly to SAP, which often involves more conservative valuations and different treatment of certain assets and liabilities compared to GAAP. This ensures that the insurer maintains adequate reserves and capital to meet its obligations to policyholders, which is the primary mandate of state insurance regulators. The regulatory justification for this is rooted in state insurance laws and the National Association of Insurance Commissioners, NAIC, Accounting Practices and Procedures Manual, which are the authoritative sources for SAP. These frameworks are designed to ensure the financial strength and stability of insurance companies. An incorrect approach would be to solely apply GAAP principles to statutory reporting. This fails to acknowledge the distinct purpose of statutory accounting, which is solvency-focused. Regulatory failures would include noncompliance with state insurance laws and NAIC guidelines, potentially leading to regulatory sanctions, fines, or even the suspension of the insurer's license. Another incorrect approach would be to selectively apply SAP principles that appear more favorable without a thorough understanding of their underlying rationale and regulatory intent. This could lead to an overstatement of financial condition, masking potential solvency issues and undermining the protective purpose of statutory accounting. This approach fails to uphold the ethical obligation of an insurance professional to act in the best interests of policyholders and the public. The professional decision-making process for similar situations should involve a clear understanding of the reporting requirement, statutory vs. GAAP. If statutory reporting is required, the professional must consult the NAIC Accounting Practices and Procedures Manual and relevant state regulations to ensure compliance. If there is any ambiguity, seeking guidance from experienced regulatory accountants or legal counsel specializing in insurance regulation is crucial. The ultimate goal is to ensure that financial reporting accurately reflects the insurer's financial health and complies with all applicable regulatory requirements, thereby safeguarding policyholders and maintaining market integrity.